The latest turmoil comes despite the president's reassurances. Remember, stocks erased steep losses on March the 9th after he said the war in Iran is pretty much complete. That's what he said. And the next day went up. And stocks got off to a roaring start on Monday when he delayed his plan for Iran to reopen the Straits of Hormuz. It went up 1%. After yesterday's selling, this Truth Social post led to a brief spike in futures, but it gave way to today's sell-off. Sam Stovall is the chief investment strategist at CFR. Sam, it is always good to see you. We'll deal with the way in which the president seems to jaw the market. But first of all, the raw fact is that despite all the best, the falls are continuing and they are pretty constant.
Yes, they are, Richard. What we find is that all sizes, all styles, and 9 of 11 sectors are in negative territory, as well as more than 70% of the sub-industries in the broad market. So it's unlike what we saw last year with the Liberation Day sell-off, because this is now a 2-variable event, rather than last year's tariffs were really the decision of the president alone.
The fact that it's gone to correction levels, 10%, we can get very excited by it, but is it significant per se?
Not really. There have been 25 corrections since World War II. The amazing thing is that they take about 4 months on average just to get back to break even. So by the time investors have worked themselves up into a frenzy and have started to sell their equity holdings, the market's probably already on its way back to break even.
Okay, so now let's look at this ability of the president. We've just given several examples of a really bad day in the market. The president makes a statement, the market rallies. This is one of the few times when that rally hasn't held, or that spike hasn't held. Has the market got tired of that jawing it up and can now see through it?
Well, I think the market realizes that the president alone is not going to open up the Straits of Hormuz, that there has to be an agreement with the ruling party in Iran to ensure safe passage of the oil that represents 20% of the world's use on a daily basis. So we want to make sure.
So what is the market fundamentally telling us? I mean, let's strip away the uncertainty that Powell talks about and how long it's going to last. What message do you take from what we are seeing?
That incrementally, the market is worried about a global recession. Bull markets don't die of old age, they die from fright. And what they're most afraid of is recession. And so with the prolonged increase in the price of oil, that is expected to strip GDP growth. And once the economy does slip into contraction mode, that is a recession.
You mentioned this, of course. If one looks back at previous recessions, there's always been a period of dislocation, quite dramatic dislocation in the markets beforehand. And my reading of it is it gets to the point where it becomes so volatile and so disruptive that the recession becomes almost self-fulfilling.
Well, you're absolutely right. The volatility during bull market days, we only see 1% moves about 15% of the time. Yet during bear market days, we see volatility of 1% or more about 45% of the time. So it is a self-fulfilling prophecy. And let's face it, fear is a greater motivator than greed, in my opinion, because adrenaline enhances memory retention. And I think that's why the old saying, if it bleeds, it leads.
That's certainly true. I was reading in this morning's FT that there has been several bond auctions that have got away but have not got away as smoothly as they might have done earlier in the week. At the short end, sure, but that the liquidity was thin and pricing was more, and the leads the banks, the primary dealers were left with having to pick up quite a lot. What's that telling us about fixed income and worries on higher rates?
What that's telling us is that the bond market is worried that the Fed will not be cutting interest rates anymore in 2026, and that the next move could actually be a hike, that the longer oil prices remain elevated, that will also be pushing up inflation as it pushes down economic growth. And basically, we need to see lower prices to entice bond buyers.
I'm grateful to have you with us. Thank you very much indeed.